Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, it's the professor himself, Mr. James Eng. James, how are you?
Good. Thanks for having me, Paul.
James, what's going on in the Old Capital world these days? Are we having a virtual conference, something coming up? What's going on with the speaker series?
Yeah, we just had a speaker series in April on property and asset management that I thought went pretty well. Talking with 3 or 4 different property management companies about how people are operating these properties. And then May 17th, we're going to have a virtual speaker series. We're bringing in Neil Bawa to talk about capital calls and how you have to maybe talk about that a little differently with your investors and how to structure that. And so those are the 2 main big events that we have coming up.
Capital calls is kind of been a dirty word. And so in the market these days, we're going through a little bit of turbulence right now, is that, sponsors and leads have to educate the people about not only when they made the original investment into their property, but maybe 2 years later that there may be a need for additional capital for the property to keep on going until we come out of this turbulence. So we're going to bring in Neil Bawa, who's going to be an expert, kind of talk a little bit about how do you market to these people that are currently your investors and talk a little bit more about bringing additional capital in. So it's going to be a great conversation. So we want you to RSVP to the Old Capital Podcast, and RSVP to that May 17th date. We certainly would appreciate seeing you there. Good place also to get more information about what's going on. But one of the fun things that I think that I like about what we're doing is the Old Capital Live. So Old Capital Live comes out on Tuesdays. James, talk to me a little bit about Old Capital Live and what you are doing.
It's more of an experiment. James Wilson and I get on and we underwrite deals. We talk about financing. You can jump on and give us your suggestions on what we think we should pay for properties, what you think we should change on the underwriting, ask questions. So it's almost like coming to a coffee shop and just going through deals together. So every Tuesday, we jump on live on LinkedIn and YouTube, so you can check.
You definitely want to watch that. You'll learn a ton of information from the professor. He is a treasure trove of commercial real estate investing. So in the podcast today, we have a friend of ours that we've known for a long period of time. He runs a very successful mentoring education group here in the Dallas-Fort Worth area, but it's a national company. You know him as the Apartment King. We know him as a friend of ours. It's Brad Sumrock. Brad, how are you?
Hey, Paul and James. I'm great, and I'm happy to be here. And by the way, I heard you mention about capital calls. We could talk about that today, too, because we've had some experience doing that. So let's add that to the agenda.
We have a whole list of things that we're going to talk to Brad about, because we are going through some turbulent times, but we want to try to bring you up to speed about what we're seeing out there, what Brad's seeing out there. And it's just going to be a general conversation of things that we're seeing in the market right now that's going to help you become a better investor in apartments. So, James, I'm going to let you kick it off, and I'll jump in with a couple more questions.
All right. Brad, maybe just give us sort of your overview of what you're seeing out there, maybe on a nationwide basis. And then if you want to zoom in on Texas, I'll open it up for you to give your general commentary of what you're seeing out there right now.
Yeah, I mean, look, we're in a completely different place this year. Right now we're in May of 23. Last year at this time, the Fed had really just started raising rates. But, take us back to like the first quarter of 22, it was still like, interest rates were 3%. Lenders were loaning 80% loans to value. There were 30 or 40 buyers going after a deal, 6 figures of non-refundable earnest money, deals trading at numbers that didn't make sense with fixed rate agency loans. In the last couple of years, like prior to, last year, just about everything that was bought with a variable rate loan. And now we're in a completely different environment. We've had, as many people know, unprecedented rise in interest rates, completely unprecedented, by the way. A lot of these variable rate loans are that came out at 3% or at 7 or 8%. So many people didn't account for that in their underwriting. Some people didn't have rate caps, or the rate caps they bought, now they have to repurchase for 50 times more expensive. A $40,000 rate cap could now be $2 million. So, a lot of things changed, and there's a lot of operators and syndicators that need to get through this. And so that's like, for people that bought deals in that type of situation, like, we need to get through these deals. But for people that are looking to buy now, it's a completely different ballgame. I mean, I'm seeing pricing that I haven't seen since like well before the pandemic. The headwind we have is debt is still relatively expensive, but in the grand scheme of things, like my first deal that I bought in 2002 was at 6.3%, and you guys know better than me, like we could get long-term fixed rate debt right now for below that, right? So the long-term scheme of things is debt is still relatively, in the long-term average, it's not that expensive, but we're seeing, for people that have been in the business in the last decade, that is more expensive and loan to values are lower, and correspondingly prices have come down. And I'm seeing deals now, like there was a deal that one of my students was trying to buy last year in the first quarter for $41 million. And now he's making an offer on it for $30 million. I don't know if he's going to get it, but that's kind of what I'm seeing right now, is pricing has shifted literally by 20%, maybe 25%. And, what's happened is the bid ask price points between buyers and sellers is actually starting to narrow, because sellers that need to sell, they need to come to terms with where the market is right now. And so on one side, we have people that bought in the last year or two that need to get through this, and it's temporary and things will come back. And for, the word of wisdom I have for anybody that's in those types of deals, and I'm in a few of them myself, is you got to get through the deals and you got to raise the extra money and get through it. Those of us that are buying deals, and I'm in that situation too, because we're about to put a 230 unit deal under contract. We're finding opportunity now that I haven't seen in 5 years.
So let me just jump in concerning financing, and what James says, which I think is absolutely true, is survive to 25. So we got to make sure everybody continues to be able to survive until 2025. Another thing, when you talked about financing and interest rates where they're at, what's the phrase, James? Marry the property, but date the rate?
Something like that?
Close enough. So you got to make sure you have the right property. Now, we know that interest rates are high right now, but they will come down eventually. I mean, after doing this for a long period of time, you just see these cycles. Things are going to get more expensive down the road. They're cheap. They're going to be cheaper, from this period of time up and for another year or two. So, get yourself, into maybe a mentorship program, or get into an educational piece, get into somebody that can kind of teach you the business right now, and then start to assemble the capital when those opportunities show up. So James, keep going.
All right, Brad, I'm going to put 3 hats on your head today. Let's put the buyer's hat on today. So first thing, buyer's hat. When you go out, you said you're about to put a deal under contract. Talk through why you are willing to go buy a deal right now. Put the buyer's hat on. Why are you willing to put a deal under contract right now? And talk through sort of that deal at a high level for us.
Yeah. So look, like, why now? Like, and I heard this before, because I've been through the last downturn, and people were like, well, don't catch a falling knife. But how do you know when things are going to turn around? And I can tell you that when they stop raising rates or they start lowering rates, you've already kind of missed it. When you see the plants already sprouting out of the ground, you've missed opportunity. So, one of the things that comes with over 20 years of experience is we just know intrinsically like what properties are worth. And it's like, so if it's $100,000 car and I could pick it up for 80, well, yeah, maybe if I wait, I could pick it up for 70, but I still know that if I pick it up for 80, it's a good deal. And so we're seeing that now, and we're seeing, because of fear, Warren Buffett would say, be greedy when others are, be fearful when others are greedy, and be greedy when others are fearful. And there's so many people that are fearful right now that people aren't going after deals, that there's a lot less competition, and we're able to get, much more buyer-friendly terms on deals. Like, we're not going to have any non-refundable earnest money on a $40 million transaction, which is almost unheard of. So we're able to come in there and essentially get a free look at a nice asset in a great location and a median household income of $113,000 within a 1 mile ring in a great market like Jacksonville, Florida, that quite honestly just wouldn't be available at the price point that we're looking at. I think part of it is, you got to identify great markets that are outperforming the national average, which is part of my recipe. And the underwriting, we're not forecasting, heavy rent increases and all that type of stuff like we were 2 years ago. So it's a solid deal that provides cash flow. And, there's still great tax advantages. So it's we could wait and we could not pursue the deal and we could wait for something better. But, it's a good deal. And so what I've learned over the last 22 years is when you see a good deal and it's a good deal, you should try to buy it.
All right, that's perfect. So take the buyer's hat off and let's put the current owner's hat. So you are an asset manager, general partner on thousands of units. What are you seeing right now on the ownership side in terms of managing the current assets in your portfolio?
Well, I would say in terms of selling, it's not the best time to put deals on the market right now, unless you have a problem that you don't want to solve or you want to get rid of the deal, because you're gonna sell at a discount. And that's in knowing that's why I want to buy too. It's I don't want to sell anything now unless I don't want to say I have to, but I don't have to sell anything. But I got a couple properties I'm trying to sell right now, and I'm going to sell them for less than I actually think they're worth because I want to get out of the deal for different nuances. And I bought them a long enough time ago that I'm still going to make a really good return, if that makes sense, right? I bought these in 17 and 18. So instead of 3Xing my money, I might 2X my money, but I'm still going to come out good on it. And then I solve problems that I don't want to deal with. So that's my take on selling deals. And then if you have a deal that we've had a couple of deals that have variable rate debt, there's one coming up now in July that, we need $500,000 to buy another rate cap. And, we're going to fund that, and we're either going to fund it by a capital call or we're going to fund it by a GP. The GPs will fund it. And this one will probably be, because it's not $5 million. It was $5 million would need to do a capital call, but $500,000, in my opinion and experience, is any GP team should be able to cover a $500,000 blip. And so one of the things I always teach and preach is that when you invest in a deal, you need to know what the capabilities of your GP team is. Could they get through a $500,000 issue that comes up? Or are they so overextended that they can't get through it? Does that make sense?
Yeah, definitely. I mean, that's one of the many questions that LPs should ask. In terms of current owners, are you hearing anything? You guys have a large group, large community of general partners. Any other concerns out there, or what are they? I don't know if you're doing sort of weekly or monthly calls with that community, and sort of what is the feedback you're hearing from them on deals they currently own?
Well, there are some people that are in similar situations. I mean, there are going to be some people that need to do capital calls or capital contributions from GPs or loans or however they need to structure it. But there are going to be deals that need capital, like you said, to survive through 2025. And, I would just recommend in any of those situations that, when you do this capital call, let's say you're going to do a capital call, it's almost like you have to resell the investors. When they went out and originally did the deal, they had projections, they had a slide deck, they were enthusiastic, they were able to communicate to investors the vision, the potential returns, the advantages. And so you got to do that even 2 to 5X on a capital call, because now there's all the negative news, there's fear of recession. Obviously you need more capital to keep the deal going. But I could say that if you could be confidently, first of all, reforecast the deal, re-underwrite the deal based on current conditions. Talk to your investors, give them the good, the bad, and the ugly. Talk to them about why are we having a capital call? Is it because, interest rates went up? One of the deals we have, NOI is up 46%. So operationally, we're crushing it, but we had interest rate and we have to buy a rate cap. So that's what the capital call is for. Now And we were able to convince 87% of the investors to contribute. So you need to be able to put the vision together. Like, why are we doing a capital call? What is it for? What is the new outlook? How are we going to get our original investment back? And how are we still going to make money? Okay. And we all know that, I mean, look, I got into deals in 2007 and 8 that if I had to let go of these deals or sell these deals in 2009 or 10, we would have lost money. But we were able to get through that trough and hold on to the deals so that people could not only get their money back, but still make a profit. And the same thing will happen. Like, what people need to know is the same thing will happen, and this too shall pass. And I'm not just being a delusional optimist, but it will. Like, after every winter season, there's always a spring, and there's always a summer, and there's always a fall, and then there's going to be a winter. And we just happen to be in like this 10-year run where nobody experienced a downturn.
Well, let's go back to prior to the 10 years. Remember when you and I were not doing deals together back about 15 years ago or so, after 2008, where we had to pay for everything in cash? Do you remember those times?
I do. Yeah, we would syndicate deals and nobody was loaning any money. And we would just go out and put an investor syndication together and buy deals 100% cash. Would buy the price, the rehab, everything was cash. And then 2 to 3 years later, would go out and put a first new loan on it because times changed. And then we were able to come out and pull out equity on an all cash purchase.
Yeah, the markets change all the time. So this is, I agree with Brad. We're going through a little bit of a December to January piece of, commercial real estate investing. But this is the best time to kind of learn from what's going on now, and to get smarter. And so Brad does a good job by his educational and mentoring classes. Talk to me a little bit about, are you seeing, your program is just on Dallas, it's just on Texas, it's across the nation. How are people doing these days? I know you're looking to buy a property. Are you seeing other people throughout the nation buying it? Because I've seen the volume level be down probably about 80 or 85% of the number of transactions that are in the market right now. What are your folks that are buying properties or not buying properties? What's kind of the average of what you're seeing right now?
Well, I would say the properties we're buying now are going to be like really solid assets with really solid demographics. Like, there's no substitution for buying in a great market. And buying in a great market, like when I look at a deal, I look at 3 things. I look at the property itself, the underwriting. I look at the market that the property is in, and it's got to be an above average market in terms of jobs and income and demographics. And then I look at the GP team, okay? Because you got to have a GP team that has the experience and liquidity and financial resources and sophistication to get through a possible downturn. But like anything that we're looking at right now is in an above average market with above average demographics. And, the whole model of like buying something and bringing rents up to 15 to 20%, those days are gone. I mean, you still may find some of that. And by the way, rent growth is still increasing. People are like, well, rents are going down. It's like, no, the rate of rent growth is going down. So instead of like a 15% annual rent growth, we might be seeing 3 or 4%. The national average right now is like 2.6% rent growth, which is down from last year, but it's still positive rent growth. And then we don't want to be buying in average markets, Paul. We want to be buying in markets where the rent growth is still above average.
Yeah, and you want to buy in areas that are landlord friendly.
Landlord and business friendly.
You bet.
And job growth above the average of the United States, population growth, great demographics. Like the deal we're looking at in Jacksonville was 113,000 median household income. So there are good opportunities out there. I would advise people now to do not compromise your market selection. Like, market selection right now is critical. It's always been, but it was more forgiving over the last decade. Now it's not.
So we talked a little bit about, the volume of business and the opportunities to buy higher quality assets, maybe at cheaper prices these days. Let's talk about raising equity in difficult or easy or just not, it's been no effect on anybody these days. Talk a little bit about, you work with a lot of general partners and they have to go out and raise equity. Is it more difficult these days? And what are some of the things that they're talking about to bring equity in?
Well, I'll let you know when we get our deal to the market. But, but yeah, look, everything I'm hearing is, not to scare anybody, but everything I'm hearing is it is more difficult because people are fearful. And, people may have already invested in some deals that the cash returns have been, first thing that happened was, well, let's suspend cash distributions. So maybe people already invested and they're not getting the cash distributions that they were projected. And then some of these deals have had capital calls. And so there's people that are, a little skittish. But the other thing I would say is on the other side of the coin, like on any given month, I know within the Sunrock community, we might have 10, 15 deals going down every single month. So back then people were saying, well, there's not enough equity to fund these deals because there's so many deals. So like what I believe to be true is there's a lot of equity sitting on the sideline, more now than before, actually, because there's a lot less deals happening. So there's a lot of equity on the sideline that people were more scared. Does that make sense? Like there's more equity than less, but people were more skittish. But I can just tell you, like some of my students now are buying, like they recently completed a $38 million equity raise on a deal in a really good submarket. So I know the money is out there. The money is out there.
That's great. And you are completely different from a lot of the gurus. You're one of the original syndicators, mentors, educators out there in the marketplace and known as the apartment king. But you listen to, you go on Facebook or you go on LinkedIn or you go to some of these places and they have all these people that are still, that are trying to be what you are, Brad. It's very difficult for them to get there, but they're living like 2 years ago and they're not telling the truth about really what's going on. So it's a little bit of a fresh air when you can tell your students or you can tell people that are thinking about getting your program really about what's going on today.
One of the keys to success is deciding who you're going to listen to. And all the people that are my mentors are, they have more money than me. I have some apartment mentors that have more units than me. They have more perspective than me. They're in more markets. They own in more markets than me. I mean, within our community, I don't know of anybody that has more properties in more different markets than the Sunrock community, but I'm talking about individual, ownership groups. But you gotta decide who you're going to listen to. And to me, I want to listen to somebody that's been there and done that. Like some of the things I hear are like, well, apartments are recession proof. And I'm like, no, they're not. Like they do have some recession resistant qualities, but anybody that says apartments are recession proof has never been through a recession, so they're not recession proof. They tend to perform better than other asset classes during a recession, but that doesn't make it recession proof. So there's a lot of people that are just talking without having experience. And so it's one thing to talk the talk and it's another to have walked the walk. So like, I just think that it's important that people understand like who they're learning from and what their true experience really is.
I agree. James?
Yeah. Give us some of those people that you follow. Top 3.
Well, I could just say, and look, so one of them, and I don't mind saying it, like in the apartment space, like Charlie Young, a principal of Madeira, is a good friend of mine. His company, Madeira Residential, has, I don't know how many units they've owned and they've went full cycle on, but right now they're, I don't know, the 15,000 unit count, but they've had a lot more than that. And they're connected with a lot of other people in the industry and they have a lot of experience and they manage their own deals and they're still raising equity and they're doing everything that, that my students want to be doing. So he's like a great, Charlie's a great mentor and a great role model. And I watch and look and listen and understand what he's doing. And that's like one of the people, Tony Robbins is another one. He's not directly in the real estate space, but a lot of people don't notice, but I know it because I'm in one of Tony's masterminds. Like 40% of Tony's net worth is currently invested in real estate and 70% of the 40% is in multifamily. So what does that mean? Like 70% of 48% is 28%. Like, and Tony's almost a billionaire and 28% of his assets are in multifamily. Like a lot of people don't know that, but I know it. And so, and he's still investing in multifamily. And, I know the group that he invests with. Okay. There's another guy called Grant Cardone. A lot of people don't like Grant because he's flashy and all that type of stuff. But again, like he's, again, and time will tell, but like Grant's a big thinker. They have their Cardone Capital Group. They're raising money for distressed assets right now. There's going to be deals, and I'm seeing it myself. There's going to be deals that we're able to buy right now that we haven't been able to buy at these pricing and terms for 5 to 10 years.
What advice would you have for people who maybe are just stepping into the game now what advice would you have for them to really get started? Because a lot of people will come in and they are fearful, but they don't have any assets right now, so they need some help.
Yeah, first is like, and I've always said this. This is a long-term game. Anybody that tries to time things like, oh, is multifamily hot right now? Let me jump in. Oh, it's not. Let me jump out. Would be like saying, hey, like, I don't understand crypto, but everybody's doing it, so let me just throw shit at crypto or NFTs or whatever. When's the last time you heard anyone talk about crypto and NFTs? Like, seriously. So, multifamily is a long-term business. The fundamentals make sense. There are more households being created than there are units coming online. There is more demand for housing than there is supply. It's harder to be a homeowner. If you take a median family making $70,000 a year to buy a median priced home at $400,000 or $450,000, that home is hard for that family to buy. There's a phrase called affordability gap and these are all based on averages, but the average cost of buying the average cost of a median priced home is $1,100 more than the average price of a median priced apartment. So the working class family, that's honest, hardworking family, it's harder and harder for them to realize the old American dream of being a homeowner, which is an old American dream, by the way. It needs to be thrown out the window. Kiyosaki says it best, a house is a liability. It takes money out of your pocket. So renting is becoming more and more the norm. And it's harder for people. Like in 2008, my tenants were moving out of my buildings and buying homes because they could get in with 0% down with stated income, no documented income. And that's not happening now. Like the lenders learned the lesson, like you got to have 20% down. You have to have a 660 credit score. So to buy a $400,000 house, you need like 80,000 plus closing costs, and interest rates are at 6%. So like that family is going to lean more toward renting a $1,800 or $1,500 or $1,800 a month B-class apartment. So the long-term gain makes sense. And this isn't my information. These are people like John Chang at Marcus & Millichap that you guys know of, and Greg Willett and these guys. Like the long-term outlook is there is a shortage of multifamily housing projected for a decade. And COVID helped that for us. Like there was a lot of projects that became delayed or slowed or postponed or canceled.
So those are for new people coming in. What about the experienced guys that maybe they might not necessarily get foreclosed, but they might have to sell a deal at a loss or just sort of cut their deal a little short here? Any advice for those people who are trying to stay in this business because they left their former job, as whether it was engineering or being a doctor or whatever it was, and now they're an apartment guy? Any advice for those people as they go through the next couple of years?
Well, yeah, this may be an unpopular thing to say, but I'm going to say it a couple of ways. Number one is, I already said it, like you got to get through the deals that you're already in. Okay. And most of us that bought in the last 2 years have a variable rate debt. And so you got to anticipate. Tony Robbins would say losers react and winners anticipate. So like now, if you haven't already done it, you got to anticipate. You got to re-underwrite your deals. You got to see what are your cash needs going forward. And if you have capital needs, like you got to put the story together and do everything you can, James, like you said, to survive this next year. Okay. At the same time, and other mentorship groups may not agree with me, but at the same time, there's going to be buying opportunities. So like on one side of the coin, you could be sitting there saying, hey, all I need to be doing right now is focusing on the deals that I already have. But my belief is if you're doing that, you could be missing some really good opportunities. Okay. And the Rothschilds have said it best. They said, buy when there's blood on the streets, even if some of it's your own blood. So I can tell you, like, what I'm doing is like, I put 3 of my deals on the market in Q4 of 2022. One sold and it's already done. Thank goodness. And I got like a really good price on it. It sold March 3rd and I'm done. The other, I got retraded and now the buyer seems like he's bailing out. So the broker was just calling me right now, actually, like they're either going to come back at a lower price to see if I'm still a seller, or they're going to bail out, but I'm going to have $300,000 of their earnest money that I wouldn't have had. So now I get to decide, like, do I want to keep the deal? Because in this deal, fortunately, I have a 10-year fixed rate loan and I bought it in 2017. So like, I'm good keeping the deal. And I may need to put some CapEx into it to level up the property. That's one of the reasons I want to sell it is, to level up the rents compared to what's been done with competing properties over the last 5 years. We need to put more capital into the property. So when people ask, well, why are you selling? It's because I don't want to put more money in so I could keep it as is and wait for the times to change. And we could do that. I mean, we're at like 96% occupancy and it's a fixed rate loan. So like, we're not in a terrible position.
Yeah. If you had bought a property in 2015, 16, 17, 18, 19, and you put fixed rate long-term debt on it, you're not distressed. It's only been, the last 2 years.
Yeah.
That we've seen people that have been on adjustable rates with these short maturities, that's been a concern. But again, if we can kind of figure that out, James and I and the team of Old Capital try to help people try to survive till 25. That's a small group of syndicators, small group of partnerships that are in those type of transactions. So it's not everybody. And I don't want to get the impression that it's everybody. It's a small group of people that bought in the last, say, 3 years on that type of a structure of financing. But we'll get through it, and capital solves a lot of problems.
I was going to say, like, I'll just level with, like, Paul, you've heard the talking, money talks and bullshit walks. So like, money could solve a lot of problems.
You bet. So like on this deal, like, again, it's like, if I want to keep it for another 5 years, I would probably need to invest $1 million in CapEx to level it up. But another strategy is I could keep it for another year or a year and a half and still sell it and wait for the capital markets to turn around and things to turn around a little bit. Or, I bought it at such a low price point that I could still sell it at a discount, which doesn't make me happy, but I'm still going to sell it and make money. And the other thing that happened is, like, a year ago, I would have had a $2.5 million prepayment penalty on this 10-year fixed rate loan. And now, because rates have gone up, it's more like $250,000. Holy cow.
So like, the prepayment penalties on these fixed rate loans have really went down. I could sell it for $3 million less than, or $2.5 million less than I would have last year and still break even. Does that make sense?
It makes 100% sense to me and to James too. James, any final questions before we wrap this up?
No, I mean, I know you guys put on a lot of events. Are there any upcoming events or things that you guys are doing here in the next month or so, or couple months?
Yeah. So every year we do what we call our Apartment Investor National Conference. We call it AIM NatCon, AIMNATCON. And it's our 6th one that we're doing. And if there's one event that people need to go to for multifamily in 2023, it's this event. It's August 25, 26, 27. And what's going to happen is, number one is I'm going to be tackling, like, real time where we're at with everything, like with buying, with selling, with refinancing, strategies, tactics, asset management, recapitalizations, like any capital calls. Like, we're going to be tackling all those types of issues. And opportunities, like, there will be opportunities, already opportunities now. By August, there's going to be even more opportunities. So people need to be educated and ready, and they need to be in the right room. And I've created that room. You guys know that because you guys have been at this event. But not only that, this event is not just about me teaching this stuff. This is the one time a year where I bring in some of the best educators in the planet. So like, Charlie has been here. Charlie Young has been here. I could already pre-announce, like, John Chang is going to be at the event with Marcus and Millichap, giving us like a real-time update on, John is one of the industry experts on market forecasts, and what's happening in the market and what do we expect going forward and where are cap rates and occupancies. Like, he's the senior vice president of Marcus and Millichap that heads up all their research. So he's going to be there. We've had Grant Cardone in the past. We've had Robert Kiyosaki in the past. We've had Ed Milet. We've had Jesse Itzler. We've had Damon John. And we will have an amazing lineup with multimillionaire speakers. Some of them could be billionaire speakers, where not only are we going to learn how to thrive in this current environment, but we're going to learn from some of the best entrepreneurs and business owners in the planet. And look, they've all been through a downturn and they've all survived and thrived. And some of these people like Damon's a billionaire and Jesse Itzler's a billionaire. So like we're going to have an amazing lineup of speakers that will move the needle in your life. And that's why you need to be there.
Brad, I'm going to put you on the spot. Who's your number one favorite speaker that you've had at your event?
Ever?
Ever.
Oh my God. Well, I'm a big Jesse Itzler fan. I mean, I'm a huge Jesse fan. He's just an expert at living a full life and dropped so many nuggets of how to live a full life. And then Ed Milet last year was like incredible. I mean, just, in his book, The Power of One More, of like, making one more offer, analyzing one more deal, making one more phone call, doing one more rep is a transformational thing where so many people are so close to success and they almost have it and they give up.
What I like about Brad's event is it's education for one thing. It's not 100% on apartments. It's more of like mindset, and certainly do like mindset, but also too is you're with like-minded individuals that like to network and like to talk and like to figure out who they can partner up with future transactions in the future. Go ahead, James.
I was going to say, the first time I heard Jesse's story of where he was out in Atlanta and they brought him up to the stage and he threw out t-shirts and got the hell out of there. That is probably the most hilarious story I've ever heard. So yeah, Jesse is a hoot to listen to. So, well, that's all the questions I had. Paul, anything else before we wrap up here with Brad? Any final comments?
No, I think, we've known Brad for a long period of time. He does a very, very good job at educating. His ear is on the street about what's happening with multifamily. I mean, he's a straight shooter. Listen to Brad, go on to bradsumrock.com to get more information about what's going on. We'll put that in the show notes too. Again, if you think we bring additional value to you, please give us a 5-star rating on iTunes. We certainly would appreciate that. So on behalf of Brad Sumrock and James Eng, I'm Paul Peebles. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.